Welcome back, everyone, to Stay in Your Lane. I'm your host today, John Mahle, brought to you by Triple T Transport. And as usual, I always share that we are a 100% employee owned company. Today's podcast, we're going to be talking with one of my favorite guests. Sorry, Lewie, it's not you on this one. It's Dan North, Chief Economist, Allianz Trade. Dan, welcome back. We spoke at the beginning of the year and at the end of last year. And I would love to understand what you're seeing. We've got a war that started. We've got fuel skyrocketing. We're going into second quarter. We saw a lot of positives from some perspectives in the economy, and we're still seeing and feeling some of the negatives. So I'd love to hear from you, Dan, on what you see and where you're at.
Well, let me first start talking things outside of the war to give us sort of a background of what's going on in the economy without that shock. Economists call it an exogenous shock, which just means from outside the system, but it sounds pretty snazzy. But I just want to look at what's going on, and I always kind of look at two sides of the economy. One is the growth side, which is output, production, and employment. And then there's the inflation side, trying to balance those two, which is what the Federal Reserve is always trying to do, is balance those two, inflation versus growth. It's kind of a tricky balance right now, even before the war came along. Inflation has been really sticky. It's not moved sideways. It's been trying to, it was very, very high in 21 and 22, up towards 8 or 9%. And they were able to get that down by raising interest rates. And that was pretty successful, but it got to a certain point of around 2.5%, depending on which measure you use now, but hasn't gotten down to the preferred 2%. It's not that big a deal, but that's the target. But inflation isn't going anywhere. Two of the reasons are, if you look at what people actually spend their money on, the two biggest things are healthcare and housing. Spend more on healthcare than housing, food, anything else. And that's only going to continue to grow because we're getting an aging population that needs more and more healthcare. Both of those items, healthcare and housing, the prices on those are growing faster than the average price, the consumer price index. So, if a big chunk of it's growing faster than the average, it's not going to slow down. The average is going to, is not going to go down at all. So inflation is really sticky. It's unlikely to go down much, if at all. That seems to be, a lot of people or economists worry about that. But we've got to remember we're at 2.5% in the stagflation era of the 70s. We're talking about inflation at 12%. So even though it's not where we want it to be, it's pretty low historically. It's pretty low. The other side of the Fed's balancing act, their mandate, is the growth side. And economists always like to look at things called gross domestic product, which is the broadest measure of the economy. It's what everything that's produced by the economy. If you think of it as one big factory door, it's what's produced by that factory. That's why it's a product. And that's pretty interesting. But really what's important is, I think, is employment. Are you employed? Is your neighbor employed? Is your son or daughter employed? Labor market. That's the thing that I think is the most important measure. And it turns out that not only is the overall labor market weakening, we've been getting a number of months where we've actually had losses in job growth. If you strip out that category again of healthcare is where all the jobs are. If you strip out healthcare, the economy has lost jobs in 11 out of the past 24 months. So we're getting to see some pretty shaky conditions in the labor market. Another way to look at it is over the past 2 years, healthcare has created 1 million jobs. The rest of the economy is 240,000 jobs. So it's no way to run a railroad if you're growing the labor market on one industry. Again, the good news is since we're going to have an ever aging population, we're going to continue to need healthcare. But it's fragile, I'd say. And overall GDP at the end of last year was terrible, was very, very slow. So it's a really tough balance now between inflation and growth. It's very hard to manage that at the moment. The Federal Reserve is going to be looking at that and saying, well, up until this war started, everybody was saying, oh, the Federal Reserve is probably going to cut one more time because inflation seems to not be moving that much, and the economy really looks like it needs a boost. So the Fed will probably lower interest rates. What do you care if the Fed lowers interest rates 25 basis points? Well, you care because it influences a lot of other interest rates, like auto loans, for instance. It makes a difference. So it's a big decision. Now, with the war, it seems like the most likely outcome is there won't be another interest rate cut this year. There will be inflationary effects, obviously, with gasoline and diesel prices soaring, really at record rates. I just made a calculation here at how fast diesel prices have soared. I see 40% in 1 month, and the previous record was 27%, and that was when the Ukraine invasion happened. So it's a very, very steep increase. And the trouble with these increases, whether they're gasoline, diesel, or oil, is guess what? The prices are sticky. They go up pretty quick, but they don't come back down. So that is going to be a weight, I'm afraid, going forward. If you look at a chart over time, it looks like, oh, it's a spike that goes up and then it goes down. Yeah, it goes down, but it takes months, years to get back to where it was before. So this is going to be a weight, I think, on the trucking transportation industry for some time, I'm afraid.
So let me interrupt you there. I've heard financial analysts say that if we can get in and out of this in a timely manner, then and get the fuel moving, then the price will come back off and not be as sticky as it was. What is your impression of that being realistic?
I don't know what the rationale for that could be. So what are we on the 20th? We're 3 weeks into this. And surely we're looking at a few more weeks. And to say prices have soared dramatically, obviously on Brent crude, the global benchmark has soared. And I don't know. I can't say that if suddenly Iran surrenders and said we give up, that prices are going to come back down, because these things take a long time to normalize. For instance, they've got the Strait of Hormuz, not virtually closed off. Let's say, how are you going to get that back up to 100% right away? Well, it just doesn't happen right away. It takes a little bit of time. So I have a hard time buying that things will all be back to normal if we get out in a few more weeks. I think it's kind of, it may be getting late for that.
Dan, question for you. Do you think where oil's trading at now, I think when we walked in here, is trading around $95 a barrel. It has been bouncing between 95 and 100 the last 7 to 10 days. Do you think it's stabilized at that point? Do you think it's a short-term stabilization? If so, is it going to continue to slowly tick up? Where do you see oil kind of stabilizing at, or when it starts to go down, or will it continue to go back up?
This is the kind of thing I hate to say. I really couldn't say. The ultimate path, of course, is the duration of this conflict. That's what every analyst will base it on. It's how difficult it's going to be to endure, and what effects are going to be is how long this goes on. Well, I don't know how long it goes on. You guys have any idea How long it's going to go on, I don't know. Again, I don't think prices are going to suddenly go back down to where they were, would be my thinking on it.
I think we need to take a moment and thank all of our service members that are putting themselves in harm's way. I don't know that there's enough gratitude for that. I think we're all fortunate because, my grandparents fought in World War II. My father's unit was called to Vietnam 3 times and sent back because they weren't trained on new enough equipment. So he didn't end up going to Vietnam. But I think we all believe that we owe a debt of gratitude to everybody who has chosen that path for all of our futures and our support throughout, whatever it does take. Back to understanding, fuel's going to be sticky at some level. I would agree with you. I know that's the 35,000 foot view. And I asked Lewie to be on here because I wanted his take. We just saw probably the most aggressive increase. Now, fuel was down pretty reasonable a few weeks ago, Lewie. A month ago, fuel was not a huge factor in our business and in our day-to-day. It was pretty stable and pretty low compared to what we've seen before. And it shot up over a week's period of time. Now, in our industry, that first week is always the hardest because in our industry, fuel's normally paid a week in the rear because you follow what becomes the national average. It's just a week late getting to you. And I don't know if people really recognize and realize that if your operating expenses just went up 30 or 40% overnight, that it takes cash flow to manage that and then also to keep it up moving forward. Lewie Pugh, everyone, Vice President of OOIDA, Owner Operator and Independent Drivers Association, and a great friend of mine. Lewie, what can you share with what you're seeing and what Sam and I are hearing, but Sam's hearing it on the ground floor also?
Yeah, I mean, you're right, John. I drive by Love's every day, back and forth to work, look at fuel there every day. And the Loves that I'd pass, and within a week's time, it jumped on $1.40 a gallon total. It went from right around $3 up to $4.40. Now, and that was within the first week of all this. Now that we're 3 weeks in and to what's going on in the Middle East, it's up to $5.40. So $2.40 in a 3-week period. Diesel fuels jumped at that one station. And there's a couple other truck stops coming that's the same way. And of course, there's some cheaper, a little cheaper, but all of it's, between $4.75 and $5 something a gallon here in Missouri. Close to where Kansas City. And this is a double punch, in my opinion, to trucking, because as we all know, we're tailing out of or at least we think we were tailing out of what was the longest freight recession in trucking history. Rates have been down due to overcapacity during COVID and just too many trucks and too much equipment that was out there. And, so rates have been in the tank forever. When the sad thing about that is the good operators, the good companies, the good carriers, the good small business folks who know how to run their business, knew their cost of operations, had capital. This has went so long, it's even affected those folks.
Correct.
I'm not saying they're living hand to mouth, but it's gotten really, really tough on the good people.
Agreed.
And when I say good people, good business people.
Yep.
So now we do this fuel thing, and I mean, it just seemed like rates had kind of bottomed. Maybe they were starting to inch back up, and then boom, now we get hit with diesel fuel jumping over $2 a gallon in 3 weeks.
Continue watching on the next episode of the Stay in Your Lane podcast.